Imagine finding out the money from your local school bake sale is legally required to be tied up in 50-year-old government bonds.
Right, or worse, discovering that a charity you donate to is secretly taking out massive bank loans to basically gamble on the stock market.
Yeah, exactly. Welcome to our discussion today on the invisible and honestly high-stakes world of charity finance.
Yeah.
Because when you donate to a cause, you naturally picture your money going straight into action.
Buying medical supplies or, funding research.
Building a community center, it's a very direct, tangible image. But there are these massive pools of surplus funds and endowments sitting in the background. We're talking about millions of dollars that organizations just hold on to ensure they can keep the lights on year after year.
And people really crave that straight line from their wallet to a good deed. I mean, we want visibility. We want to know the $20 we gave bought $20 worth of food for a food bank.
Right, of course.
But step behind the curtain into charity investment governance, and that straight line completely vanishes into this massive, highly regulated matrix. Managing this money isn't just about logging onto a brokerage account and trying to beat the market.
No, it's a legal minefield.
It really is. A single misstep can expose the charity to severe regulatory penalties. It can inflict personal financial liability on the board members themselves and fundamentally damage the cause they are actually trying to support.
So today we are exploring how these organizations manage millions of dollars in the shadows. We are going to look at the real rules of the game. Because a volunteer charity board doesn't just get to open a day trading account and start buying tech stocks.
Definitely not.
They have to navigate a very specific legal framework called fiduciary duty. But let's start with the absolute basics. If I volunteer to sit on a charity board and we have $1 million sitting in the bank, what are the default rules? How am I supposed to invest that cash?
So the default standard in most jurisdictions, like Ontario, for example, is dictated by the Trustee Act, specifically something called the Prudent Investor Rule.
Okay.
It is a principles-based standard rather than a strict checklist. It basically requires trustees to invest the organization's property the way a prudent investor would, meaning they have to exercise, reasonable care, skill, and caution.
That sounds incredibly broad. So they just invest it like any responsible person managing their own retirement fund would?
Broadly, yes.
Yeah.
It gives boards the flexibility to build modern, diversified portfolios. Historically, there used to be these incredibly prescriptive authorized lists of what a charity could or could not buy.
Oh, interesting.
Yeah, but the prudent investor rule swept those away to allow for modern financial theory. But, and this is crucial, that rule is absolutely not the final word.
What do you mean?
The default standard can be completely overridden by the organization's own historical paperwork. We are talking about things like letters patent, private incorporating legislation, or specific endowment agreements tied to testamentary gifts.
Wait, back up a second. Testamentary gifts, you just mean a will, right? Like somebody dies and leaves $1 million to the charity in their will.
Precisely, a bequest in a will. And letters patent is just an older legal term for the founding documents that officially created the corporation.
Got it.
So these historical texts can impose rigid, binding constraints on how the money is allowed to be invested. If a volunteer board ignores those constraints, they are breaching their legal duty no matter how much money they are actually making.
Wow.
Let me give you a concrete example from the case files. Consider a faith-based charitable foundation that was incorporated back in the 1970s.
Okay.
Fast forward to recent years, and for over a decade, this board had been investing their $4 million reserve fund in a very standard, highly diversified portfolio of equity index funds.
Which is what everyone is told to do. I mean, buy a broad index fund, let the stock market work its magic, and grow the wealth for the charity.
Right. Highly responsible by today's standards. They were growing the foundation's wealth significantly, but during a routine governance review, legal counsel dusted off the original 1970s Private Act of the Ontario legislature that established the charity.
Oh no, let me guess.
Buried deep in that legislation were specific provisions restricting the foundation entirely to fixed income instruments and government bonds.
Wait, okay, let's unpack this. They are making tons of money for their cause in the stock market, doing exactly what modern financial advisors tell you to do, but they are legally forced to make less money in bonds just because of a 50-year-old piece of paper.
Basically, yeah.
It's like inheriting a high-performance sports car, but then you find a note in the glove box from your grandpa saying you are legally only allowed to drive it in school zones.
It's actually stricter than that. To tweak the analogy, it's like inheriting a horse-drawn carriage in the age of sports cars, and the law dictates you must continue buying hay and avoiding highways.
That is insane.
Well, what's fascinating here is that you have to look at the historical context. In the 1970s, interest rates were incredibly high, and bonds were considered the ultimate safe, responsible investment.
And stocks were seen as risky.
Exactly. Equities were often viewed by conservative institutions as risky gambling. So the founders hardwired that philosophy into the charity's DNA.
So what happened to the board? Did they just get a warning or something?
No, they had been operating in technical breach of their own founding statute for over 10 years. They had to immediately pass a board resolution, completely wind down all their profitable equity positions, transfer everything back into bonds, and formally report their own breach to the public guardian and trustee.
That must have been devastating for their returns.
It was. But the underlying legal philosophy here is the absolute supremacy of donor intent. The court's view is that if charities could simply ignore the hyper-specific wishes of their founders just because financial trends change, the public would lose faith in the sector.
So people would stop leaving large endowments altogether.
Exactly. Doing a quote-unquote good job financially often means doing a terrible liability-inducing job legally.
Okay, but if the rules are buried in old wills and 1970s legislation, how does a modern volunteer board protect themselves when they actually need to start making trades? I mean, they can't just memorize 50 years of paperwork.
They rely on a written investment policy. If an organization holds endowments or trust property, this document is the absolute baseline for defending any financial choice to a regulator.
So it's like a shield.
Exactly. It translates all those historical quirks into a modern operating manual. It dictates the rules for delegating decisions to external advisors, outlines diversification targets, and clarifies the mechanics of managing endowed funds.
Let's talk about those mechanics, because I imagine this is where things fall apart in practice.
They definitely do. Let's look at another case. In 2018, a community foundation received a $2 million endowment from a donor. The restriction on this gift was very common but very strict. The foundation was only allowed to spend the investment income.
Okay, so the principal is off limits.
Right. The original $2 million capital had to be preserved untouched, in perpetuity. So the board took that cash and handed it over to an external wealth advisor with a simple mandate to grow the fund. The advisor utilized a standard total return strategy.
I need a translation on total return versus income. Like, if I buy a stock for $10, it pays a 20-cent dividend, and then the stock price goes up to $12. What is the difference?
Okay, so under an income-only restriction, the charity is legally only allowed to spend that 20-cent dividend.
Just the dividend.
Yes. The $2 increase in the stock price is capital gain, and it belongs to the permanently restricted principal.
Got it.
A total return strategy, on the other hand, blends those two things together. The advisor looks at the overall growth, so dividends plus capital appreciation, and sells off portions of the portfolio to generate cash flow.
Oh, I see where this is going.
Yeah. 3 years into this arrangement, the donor's estate contacted the charity asking for proof of compliance with the original agreement. The charity suddenly realized the advisor had been using capital gains to fund the charity's operations, effectively eating into the restricted principal.
But wait, if the board hires an expensive professional wealth advisor, isn't the advisor the one on the hook for messing up the strategy? To me, this feels like hiring a Michelin star personal chef, completely forgetting to tell them you have a severe peanut allergy, and then trying to sue the chef when you have an allergic reaction.
That's a great way to put it. The law makes a very clear distinction between delegating a task and delegating responsibility.
Meaning you can outsource the work, but not the blame.
Exactly. You can hire the chef to cook the meal, you can hire the broker to pick the stocks, but the charity board cannot subdelegate the responsibility of legal compliance.
Because the chef only knows what is in the contract.
Precisely. If the investment policy doesn't explicitly state, do not touch the capital gains, the advisor will just default to standard market practices to maximize returns.
Right.
So the board had no defensive paperwork to show the donor's estate. It permanently damaged the relationship with the donor's family and triggered a complex, really expensive reconciliation process with the regulators to restore the missing capital.
Wow. Okay, so a board needs to review historical documents and draft airtight investment policies just to survive buying normal stocks and bonds.
Mm-hmm.
With restrictions this tight, I'd assume these charities are forced to be incredibly conservative. But there's a financial strategy they are legally allowed to use that seems completely unhinged for a nonprofit.
Ah, the leverage
Yeah.
loophole.
Yes.
The Canada Revenue Agency, the CRA, has confirmed that public and private foundations are legally permitted to borrow money for the explicit purpose of acquiring investments. They can literally take on debt to invest in the stock market.
This sounds incredibly risky. Taking out a loan to buy stocks is basically what day traders do on margin. How does this even mechanically work for a charity?
So, a board might take a loan from a financial institution using their existing assets as collateral and use that borrowed cash to buy a portfolio of equities.
Oh, it goes up.
Right. The strategy assumes that the dividends and capital appreciation from the new investments will outpace the interest rate on the loan. It allows an organization to access liquid cash without selling off their core endowed assets.
But what if the stock market crashes? I mean, if I'm on a board protecting a charity's future, taking out a loan to invest feels wildly irresponsible.
And that is why this requires separating regulatory permission from fiduciary prudence. Regulatory permission simply means the CRA will not revoke your charitable status just for executing a leveraged trade.
So it's not inherently illegal.
Correct, but fiduciary prudence asks whether it is smart, safe, and justifiable for this specific charity to take on that risk at this specific time.
Because if the market tanks, the bank still wants its loan back.
The debt absolutely doesn't disappear. The leveraged investment could underperform, the collateral could be called in, and the charity's ability to fund its actual programs could be obliterated.
That's terrifying.
And the CRA's permission to borrow does not shield the board of directors from personal liability if a court later determines the decision was reckless. If an organization is going to use leverage, the borrowing limits, risk parameters, and exit strategies must be meticulously mapped out in that investment policy.
Man, if the traditional stock market is this fraught with rules, historical traps, and dangerous loopholes, why bother with Wall Street at all? It seems so much safer to take the charity's surplus money and invest it directly into the cause they are trying to support. Skip the brokers entirely.
I mean, mission-aligned investing sounds incredibly noble and straightforward. Unfortunately, it is the site of the most dangerous, counterintuitive legal trap in the entire sector.
Really?
Oh, yeah. It is a direct collision between provincial trust law and federal tax law.
Okay, let's break down this collision. If we look at the provincial side, using Ontario as our baseline, they have a concept called a social investment. This allows a charity to invest money to directly advance its charitable purpose, even if that investment produces a terrible financial return by market standards.
Right, because the province recognizes that the primary goal isn't maximizing profit, it's advancing the mission. The provincial regulator, the public guardian and trustee, permits this, provided the board documents a strict nexus.
A nexus.
Yeah, a nexus is a direct, undeniable written link between the financial investment and the charity's specific legal objects. You also need a modified prudent investor analysis and ongoing monitoring plans.
Okay, so that's the province. Meanwhile, operating in a completely different universe, you have the federal rule book enforced by the CRA. They have their own concept called a program-related investment.
Yes. Under the federal framework, a program-related investment is treated as a qualifying disbursement. Charities are required by the CRA to spend a certain percentage of their total wealth every single year, usually around 3.5 to 5% of their assets, to maintain their tax-exempt status.
And this is called the disbursement quota.
Exactly. If an investment qualifies under the federal rules, the CRA counts that money as spent toward that mandatory quota.
And the trap is that satisfying the provincial definition of a social investment does not automatically satisfy the federal definition of a program-related investment. They are entirely separate legal tests.
Precisely. A board can meticulously navigate the provincial requirements, thinking they've executed a perfect mission-aligned investment, and walk right into a massive penalty from the federal government.
How does that even happen?
Let's look at how this plays out in practice, starting with a success story. A poverty relief charity wanted to help alleviate a local housing crisis. They took $300,000 of their surplus funds and loaned it directly to a co-op housing developer building affordable rentals. They only charged 2% interest.
Which is wildly below market rate,
Right.
but perfectly aligned with their poverty relief mission.
Yes, and they executed it flawlessly. They documented the explicit written nexus to their charity's objects. They secured a mortgage against the property, established a strict monitoring schedule to ensure the housing remained affordable, and reported the loans separately in their financial statements.
Awesome.
It was a fully compliant provincial social investment that provided a massive benefit to the community.
But then we have the disaster scenario where a board assumes the two rule books overlap.
Right. So a foundation dedicated to Indigenous economic development made a $500,000 equity investment into a for-profit social enterprise. This enterprise was creating vital jobs in remote Indigenous communities.
Sounds great on paper.
The board thought they had hit a home run. They categorized it as a social investment under provincial law and simultaneously classified it as a program-related investment under federal law, counting that $500,000 toward their annual CRA disbursement quota.
And then the CRA auditors showed up.
They did. The CRA reviewed the equity structure and determined its primary financial characteristic was capital appreciation, not direct program delivery. They ruled it did not qualify as a program-related investment.
Oh, wow.
Because the charity had relied on that $500,000 to meet their quota, they suddenly faced a massive, unexpected compliance shortfall at the federal level.
But the nightmare didn't stop there, right? Because the provincial regulators also audited them.
Yes. The province looked at the exact same investment and noted the charity failed to document the formal written nexus and the ongoing monitoring plan required for a social investment.
So they got hit from both sides, provincial and federal, for an investment that was genuinely advancing their core mission.
It's a brutal trap.
This feels like an unwinnable game. Why would a charity even attempt a mission-aligned investment if the government is just waiting to penalize them on a technicality from two completely different rule books? It's like trying to play a match where the referee on the left side of the field is judging by soccer rules, and the referee on the right side of the field is judging by rugby rules. No matter what you do with the ball, one of them is going to call a foul.
That is a perfect way to describe it.
Right.
The referees are enforcing different sports because they are motivated by entirely different mandates. If you look at the provincial referee, the public guardian, and trustee, their mandate is rooted in trust law.
Okay.
Their entire focus is guarding the vault. They want to ensure the board isn't squandering the charity's underlying assets on risky, undocumented ventures. That is why they demand the written nexus and the monitoring schedules.
And the federal referee, the CRA, is the tax collector.
Exactly. The federal government grants these organizations massive tax exemptions. In exchange, they want to ensure the money is actively flowing out into the world to provide a public benefit, rather than just being hoarded tax-free in a bank account forever.
So that is the purpose of the disbursement quota.
One regulator wants to protect the vault. The other regulator wants to force the vault open. A board needs independent legal analysis for both frameworks before a single dollar is transferred.
Man, so we've covered the historical traps of investing the money, the dangers of leverage, and the legal maze of mission-aligned investing. But eventually, whether a charity is making 2% on a local housing loan or 10% in the global stock market, they have to actually extract that money to buy the supplies or build the community center. How do they move the money out of the investment portfolio without triggering another audit?
Well, they rely on the second half of their defensive paperwork, which is the disbursement policy. If the investment policy dictates how the organization generates wealth, the disbursement policy dictates exactly how and when they spend it. It sets a structured annual spending rate, typically calculated as a percentage of the endowment's rolling average market value over several years.
Wait, why a rolling average? Why not just look at what the account is worth today and spend, like, 4% of that?
Because markets are volatile. If the stock market crashes in December and you base your entire operating budget on that single day's value, the charity might have to lay off staff or shut down programs. A rolling average smooths out the market's peaks and valleys, providing a stable, predictable cash flow.
That makes a lot of sense.
The policy also clarifies whether the charity is spending income or capital gains and ensures the total outflow satisfies the CRA's strict annual quotas.
Without this policy, they are basically flying blind. It sounds like trying to perfectly drain a bathtub while the faucet is still running full blast.
And if you just guess at the water level, you either flood the bathroom or run entirely out of water. A board might panic during a bad market year, hoard their cash, and trigger a CRA penalty for missing their quota. Or they might spend recklessly during a boom year and permanently erode the endowment's principal.
So they need both policies working together.
Yes. The investment policy and the disbursement policy work together as the operational engines of the charity. They dictate how to grow the assets and how to deploy the returns while proving total legal discipline to both the regulators and the donors.
I think the biggest takeaway here is a profound shift in how we view these organizations. The next time you donate to a major endowment or, if you are ever asked to volunteer your time to sit on the board of a local charity, realize what you're stepping into.
It is definitely not just about cutting ribbons and feeling good about the cause.
No, it is a highly complex financial and legal matrix that requires intense discipline and a deep understanding of some very old rules. Which leaves a final lingering question for you to consider. We look at how modern charity boards are legally bound by the hyper-specific wishes of donors and incorporating documents from 50 or 100 years ago. So if our largest charitable institutions are legally forced to prioritize the instructions of dead donors over modern financial reality, are they actually equipped to flexibly solve today's rapidly changing problems? Or are they ultimately just trapped, managing the financial ghosts of the past? Something to chew on.